Hello, everyone. I'm looking forward to spending some time with you to discuss financial wellness and important information to get you on the right path to a successful retirement. Thank you for taking time out of your day to make this a priority. We know life gets busy and financial wellness can sometimes take a backseat. So I commend you for taking time for the first step in this process. So what we want to do today is break down these topics for you and help you come up with a plan for your financial future. We know each of you have a unique situation, and we're happy to help you build your own personalized plan. First, I'd like to share a little bit about myself. My name is Leslie Weidel. I have been an agent consultant with Horace Mann since 2012. Every week, I get the opportunity to visit schools and my new agent team and work with educators across the Northeast region. Being in schools every week, I'm able to see the challenges that our educators and administrators face. Our goal at Horace Mann is to be able to provide solutions and help support the educational community. We know you are busy taking care of our children's future, and we want to help you take care of yours. Next, I'd like to give you some background on Horace Mann. We were founded in 1945 by two teachers. We were started as an auto insurance company for teachers and quickly grew into the largest multi-line insurance company focusing on the educator market. When we say educator market, we mean anyone employed by the district, whether you're a bus driver, cafeteria worker, or work in the administration office. You are eligible for our special Horace Mann benefits. Our programs, product features, discounts, and services are specifically designed with educators in mind. We partner with education associations locally and on a national level to understand the key issues impacting educators and learn about ways we can provide solutions. So we've taken that information and built workshops around addressing teachers' needs just like this one. So another workshop example is our Donors Choose workshop. In this workshop, we help connect teachers to free classroom supplies. One of our most popular workshops right now is our Student Loan Solutions. This is where we help teachers get their student loan debt forgiven via the federal programs. We know this process of getting your loans forgiven can be very complex and confusing, so we're right here to help you through it. You might have also seen us on your campus spoiling the staff with appreciation events and recognition programs. We love to give back and help whenever we can. We understand the stress and pressure that educators are under right now, and one way we can give back is through our financial wellness program. At Horace Mann, we work hard to understand educators at every stage of their career, from teachers just getting started to our established educators nearing retirement and already retired. We look at every stage to specifically address your ongoing needs and goals. We also want to understand from an educator perspective, what are some of the challenges they are facing? And what does that impact have on a school district? In a recent survey, nearly half of our educators say that they are just getting by financially. We also asked educators what could be done to help them stay in the profession. 57% of them said if they had better compensation, they would be more likely to stay in education. Compensation is a really hard thing for us to control, but doing workshops like this, helping you hear about your financial wellness and how to protect your financial future, now those are things that we can help with. So today, what we want to do is truly think about the lives of our educators and really how it impacts our female educators. So we will start by running through some statistics, then we'll cover some important information about the elements of retirement and break it down piece by piece. We know this topic can feel very complex and we want to simplify it for you. So let's start with those statistics. An interesting fact. Today, women control a third of the total U.S. household financial assets. So if you look at that next bullet point, you'll see more assets will shift into the hands of U.S. women over the next 3 to 5 years, representing $30 trillion by the end of the decade. So in general, women are not only contributing to household income, they are managing and making up the majority of the financial decisions. It's so important for us women to understand our finances make educated decisions, and set ourselves up for success. Today, joining this call is the perfect first step. We also know that females face unique challenges. So if you think about life expectancy, we know that females traditionally live longer than males, statistically about 5 years. Therefore, we're going to need to have more in savings and retirement. In addition to the money we need to be saving, we need to take into account inflation and higher healthcare costs. We also know that women are often caretakers, taking care of children, aging parents, and sometimes that can cause us to step away from the workforce early, affecting our ability to save. These are important factors for us to consider as we start thinking about our retirement goals and financial future. Another stat I want to share with you is, according to Forbes, 90% of U.S. women are involved in household financial decisions. All right, so this is the place I want you to start thinking. I want you to take a moment and think about your personal priorities. I know this might look a little different for everyone, but what's important to you? What are your personal priorities? This list is an example of answers we've gotten in the past from previous attendees. I've heard before, this is the first time I've actually taken a moment to really think about this. We're all so busy with life that sometimes thinking about what you want for your financial future can kind of go by the wayside. Let's take a moment today to jot down some thoughts you have on this as a takeaway from the session. Maybe it's a beach house, traveling, or spending more quality time with the family. Or maybe it's not even on this list of examples. Once you know what those personal priorities are, it helps to build the framework on the things that are most important to you so we can build a plan to reach those goals. So I want to pose a question, and the answer may surprise you. Do women spend more money than men? The answer is yes, we do. And there's a reason why we do. We spend more than men because we live longer than men. So we have to be very thoughtful about saving for our future because we're going to need a bigger nest egg. For healthcare, according to Women's Health, women actually spend 69% more out of pocket for healthcare costs. If you think about preventative care, wellness screenings, we do have more out of pocket expenses than men. Transportation. I was surprised when I learned this. Women actually pay more for car ownership, all the way from the purchase to the repairs. I know when I go to get my oil changed, I'm not an expert on my car, so when the body shop is making recommendations, I kind of just go with it, and I end up spending more than I anticipated. So I wanted to spend some time talking about the pink tax. Some of you may have heard of this before. This is something that shocked me. Products that are marketed to females are more expensive than the same products marketed to a male. So I have some examples for you. You can check this on the Target app. Degree deodorant for men is $3.39. The exact same brand for females is $4.49. I have another example for you. Gillette razors for women, you can get 6 for $27.99. Gillette razors for men are 10 for $23.99. I started comparing several other items and was so surprised. So yes, we do spend more money than men over a lifetime. There are 4 things you can do now to make your money work for you. Manage it, establish good credit, protect what you have, and put money away for a rainy day. And the good news is taking charge of your personal finances doesn't have to be complicated. There are some practical steps you can take to make the most of your money. Remember your priorities from earlier? Your family, paying down debt, and saving for the future, being able to pay bills if faced with a job loss, being happy, work-life balance. Let's take a look at some ideas that might help. It's important to live for today, but prepare for tomorrow. And the good news is taking charge of your personal finances doesn't have to be complicated. There are some practical steps you can take to make the most of your money. We'll start at the beginning. budgeting and spending money, and finish by talking about the importance of saving and putting money aside for retirement. So a good place for us to start is credit. It's such an important topic for us to understand how credit scores work, making sure that we are looking at our credit and monitoring it on a regular basis. There are several free services that you can use to monitor your credit. We'll be giving you some tips and ideas on how to manage your credit. Credit scores generally range from 300 to 850 points. It can impact many aspects of our life. It can impact if we are approved for a loan or not, the interest rate we get on a loan, whether it's a car loan or a home loan, and it can also impact your insurance premium and your credit limit. Here's a couple things you can do to establish good credit. Start by getting a credit card. A credit card is one of the most valuable tools in your arsenal. That said, there are a lot of options out there: rewards cards, balance transfer, credit charge cards, student credit cards, and more. Each card will offer different things. Look for the one that is the best for your situation. Make your payments on time. I know it sounds obvious, but even one missed payment can hurt your credit score. Make sure you're at least making your minimum monthly payments. If you can make additional payments, focus on paying down the largest balances to get your credit utilization ratio down. Keep an eye on your credit utilization ratio. You'll want to keep this number as low as possible. For example, if your credit limit is $1,000, then keeping it under $300 at any time is favorable. This doesn't mean that you can't make larger purchases. It just means that making larger payments to drop your balance back into a healthy range is advised. This will often mean making more than one payment a month. In the feedback we've gotten from other sessions, we've found that discussing weighting factors for credit is very helpful. So you may want to write a few of these down. I want to walk you through some of the factors used when calculating your credit score. 35% of your credit score is based on your payment history. So a good rule of thumb is to try to get everything set up on auto pay. Missing one payment can stay on your credit report for 7 years. Another factor is 30% of your credit score is based on the amounts that you owe. So I want to give you a good trick on this one. The credit reporting agencies will typically pull balances when your credit statement is generated. So I try to pay my balances 7 to 10 days before my statement is generated. So if you can get in front of that before they pull your balance, it will actually show a lower balance and improve your score. If you have an older credit card that you are debating on canceling, older credit cards will show that longevity, so you may want to keep that card. 10% of your score is applying for a new credit. So just be mindful when you go shopping. You don't want to say yes to everyone who offers a deal for you to sign up for a card. 10% is also on the type of credit you are applying for. So if you're saying yes each time you go to a retail store, the credit bureaus can get nervous when they see a whole bunch of one type of credit. A couple other things to mention. If you max out a credit card, it could knock anywhere from 10 to 45 points off your score. So it's really important to try to keep those balances low. Also, just missing one pay cycle can knock off 60 to 110 points. So it's very important to set up that automatic payment and make on-time payments. Reviewing your credit report. Carefully reviewing your credit report will allow you to catch any errors and dispute them. There are a lot of free different options. We recommend you look around and find the one that works best for you. What you will see in credit reporting will give you pointers on things that are helping your credit and things that might be hurting it so that you can work to improve your score. Horace Mann does give our educators free access to a credit monitoring app called HM Score. You are able to access this through horacemann.com. Next, you'll click Programs. Then the third step is HM Score on the dropdown, and then register from there. What you will see in your credit reporting will give you pointers on things that are helping your credit and things that might be hurting it, so you can work to improve your score. What you might not be aware of is student loans can actually affect your credit. So we always encourage you to make sure you are paying them on time so it doesn't hurt your credit. And these on-time payments can actually help your credit because they're considered installment loans. The lender reports these to the credit bureaus and you begin to establish a track record. Interestingly enough, women hold 2/3 of the student loan debt. What we see a lot of times for females is they often have their own student loan debt, but they are also taking on the loan debt of their children as well. 60% of educators have student loan debt, so you're not alone. And that's one of the things we talk about with our administrators. We want to help. Horace Mann has been helping educators manage their student loan debt, identify forgiveness opportunities, and get on the path to financial success since 2016. There's a federal program for forgiveness out there, but it can be very complex and cumbersome to navigate. So we've actually created our own program to help educators get all the way through the process. On average, we save teachers $275 per month in loan forgiveness. We have a team that can help you determine which program is best for you and assist you through the process to lower your payment and even get your loans completely forgiven. I want to share a recent loan forgiveness experience with you. We had an assistant principal that had over $200,000 in loan debt and was paying $1,300 per month. We discovered he was eligible for a one-time adjustment and his loans were completely eliminated. Just a great example of one of the ways that we can help. The next thing we want you to think about is a savings plan. This is vital to a woman's success in financial situations. Including a savings plan in your financial plan can help you respond to the unexpected. Let's look at the two ways people save. You'll hear, I live paycheck to paycheck, and I don't have anything left over to save. Some people pay their bills, buy clothes, go out, and then save whatever is left. Others save first, then pay their bills and spend what is left. You want to be the person who pays yourself first and spends second. This strategy can put you in a really good place for a great future. Life insurance for women is a crucial part of financial planning for the whole family. It's there to protect your loved ones. Imagine if you became ill or passed away. A tragic event will not only result in an emotional loss, but a substantial impact on the operations of the household as well as the finances. You'll notice at the top of this slide, only 47% of women own life insurance compared to 58% of men. We get the question a lot, how much life insurance do I need? This is a good slide to help you calculate how much life insurance you need. As you review the bullet points, be thinking about the needs of your family. Life insurance can help you pay off debt, mortgage, taxes, medical bills, as well as offset other expenses. If you are a caregiver, single parent, or a working mother, life insurance can help buffer the loss of your income. It can also support future expenses for your children or family, such as educational expenses. Putting a plan in place now will not only help give you peace of mind, but it can also help put your loved ones in a better position to meet their future needs. Many employers offer life insurance coverage for employees and their spouses. But keep in mind that those policies will typically not remain in force if employment is terminated. In addition, employers can make changes to benefits at any time. So it's important to have a life insurance policy outside of work in order to secure your rate and keep your own policy if you happen to leave your job or even when you retire. Remember, we talked about how women face unique challenges that can impact their retirement. Increased life expectancy and greater retirement needs, longer exposure to inflation, rising healthcare costs. Women educating themselves about investments and long-term planning can help us feel more comfortable with understanding the risk we are willing to take and the investments that marry with those risks. This is one of the number one questions that we get. How much income do I need for my retirement? Experts say you need about 80% of your pre-retirement income in retirement. So if you make $80,000 now, you'll need about $56,000 per year in today's dollars after you retire. However, if you plan to travel frequently in retirement, you might want to aim for 90 to 100% of your pre-retirement income. On the other hand, if you plan to pay off your mortgage before you retire and maybe even downsize your living situation, you may be able to live comfortably on less than 80%. The idea is once you retire, you'll be able to eliminate certain expenses. Very rarely do I hear, "I've saved too much for my retirement." How do you know you can live off the 80% when you retire that we mentioned earlier? A great way to find out is to take your retirement for a test drive. What I mean by that is, before you officially retire, you can take the 20% of your income and put it into a savings vehicle. That way you're experiencing what it's like to live off the 80%. Not only will you accumulate more in savings doing this test drive, you will also have the peace of mind and security of what to expect going into retirement. Now we're going to cover some of the options available to you to help you save for your retirement. Do you know how your state teacher's retirement system works? Do you know how your pension is calculated? Although we don't have time to go in depth today, it's important to keep in mind that even if you do qualify for an STRS pension and Social Security, it may not be enough. If you are covered under a retirement system where you do not contribute to Social Security, your gap could be larger. Many educators can take up to a 40 to 60% pay cut when they retire without proper planning. So you may want to consider supplemental savings to help make up the difference between your income before retirement and after retirement. You will no longer have some of the expenses associated with working, like commuting costs, things like that. However, depending on the retirement lifestyle you would like to enjoy and those personal priorities we talked about, your goal may be to maintain approximately the same income you had while working. And there are a number of ways to save for retirement. One way you can put away money for retirement is through a 403b plan. It's similar to a 401k, but generally only for people in public education and a nonprofit organization. A traditional 403b plan is tax deferred. Your money is taken out of your paycheck on a pre-tax basis. That means federal income taxes, and in most states, state income taxes are not withheld on the amounts you contribute. You'll pay income taxes on distributions when you retire. You may be eligible for an additional catch-up contribution if you're over the age of 50. Contributions to a 403b plan should be considered long-term investments. Generally, due to IRS restrictions, you may make a withdrawal from a 403b only upon reaching age 59 and a half, severance from employment, disability, or certain other hardships if allowed by plan. Your employer's plan may have additional restrictions on distributions. If you do need to take money out before age 59 and a half, you could be subject to a federal penalty tax of 10% in addition to income taxes. You should consult with your tax advisor regarding any tax-favored products. I know we've all heard of a 401k. This plan is very similar to the 403b. It's just primarily offered to companies that are for-profit. The next plan is the 457 plan. This is also an employer-sponsored tax-deferred retirement plan offered to state and federal government employees. The 2025 annual contribution limit is $23,500. Your employer may allow an additional catch-up contribution of $7,500 if you are age 50 or older, or a special catch-up contribution during the last 3 years prior to normal retirement age if you have not contributed the maximum amount in the prior years. The special catch-up contribution is 200% of the annual limit, or the annual limit plus the portion of unused annual limits from prior years. You can also save for retirement with a traditional IRA, which is a type of retirement account that allows earnings to grow tax-deferred and contributions may be tax-deductible. Tax-deductible contributions have eligibility requirements based on income, tax filing status, and participation in other retirement plans. Distributions are subject to income tax and may be subject to a federal penalty tax if distributions are made before reaching age 59 and a half. You can contribute to a traditional IRA in several ways. IRAs have annual contribution limits, which are significantly lower than the 403b or the 457b plans. If you are under 50 years of age at the end of 2025, the maximum amount that you can contribute to a traditional IRA is the smaller of $7,000 or the amount of taxable compensation for 2025. If you are over age 50, you can contribute up to $8,000. Contributions to traditional and Roth IRAs are aggregated for purposes of annual limits. IRAs should be considered long-term investments. If you take your money out before age 59 and a half, you could be subject to a 10% federal penalty tax in addition to income taxes. You should consult with your tax advisor regarding any tax-favored retirement products. You can save for retirement with a Roth IRA, which is a retirement account that allows after-tax contributions and distributions are tax-free if made after age 59 and a half, and having the Roth IRA in place for 5 years. There are eligibility requirements to contribute each year that are based on your annual income and tax filing status. The IRS sets limits on how much you can contribute to a Roth IRA. The annual limit for 2025 is $7,000 or $8,000 if age 50 or over and eligible for a catch-up contribution. Contributions to traditional and Roth IRAs are aggregated for purposes of the annual limits. The last thing I want to mention is another important part of your financial future to consider. As important as knowing all of the pieces of the retirement puzzle is, it's also important to have a strategy to make certain that you maintain control over your assets and ensure that what happens in the event of your disability or death is what you would like to have happen. The first thing on this list is establish a will or trust outlining how you want your assets distributed upon death. Speak to your attorney to decide what is best for your situation. Establish a financial power of attorney document to allow for management of your financial affairs in the event you are unable to do so. Prepare an advance care directive, sometimes called a living will, that indicates your medical care preferences in the event that you are unable to relay your wishes. Make sure your beneficiaries are current on all of your retirement plans and life insurance, and that they know how to access your accounts, including state teachers' retirement system. We often see new teachers elect their beneficiaries as their parents when they start teaching, and then they forget to update them when they get married. The choices about your estate are yours to make, but I encourage you to seek the advice of professionals in these areas to make sure that your choices are documented. To recap, here are the next steps we discussed. Establish a budget, continue to monitor your credit, make sure that you have addressed your life insurance needs and beneficiaries, and lastly, review your household retirement plans. Remember, you should be living for today and preparing for tomorrow. Thank you for your time. I know this was a lot of information. If you want to know more about anything I discussed, please contact your local Horace Mann agent directly at 800-999-1030. Thank you.